Good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for Saturday, December 18th, 2021. I want to start with the Q&A session for the foundations. So we do that on a weekly basis every Saturday. These are the recorded Q&A sessions from the first two completed foundations courses we did this year, the April session, the July session. So those are the two sets of Q&A notes that Griff Cooper and Phil Wu did for us. The October 21 session is still working along here. We don't have an intern yet working on those, but if you're interested and you're in the sound of my voice and you want to work to the same level of quality that Phil and Griff did, just contact me and we'll get you started on that. So let me zoom down to the questions that were answered this week. So, we get the answers in writing and posted. So we have a written FAQ as well. All right, so this week, just one question from Les, who I see is here tonight. So well done, sir. So I find I get stuck when either a collapsing dragon or a supported spring crossing happens fast. And this is mostly happening with the collapsing dragon, as I can recognize a kata 2. Can you give some insight about what to do if a collapsing dragon happens quickly? Should I just leave it and wait for a reentry or just jump in? So here's what I would say on that. So the essence of this whole sequence begins with a harsh winter. So there was probably some period of chop, and then some breakout from that sideways chop occurs, and you get this non-controversial large move. It is unquestionably a large move. How do I know if it's a unquestionably large move? Because you look at it and say, well, that was a large move. That's the standard. We're also looking for a MACD in the winter, and we'd like to see that outside of the Red River. And that tells you you have a large and a sharp move that took the MACD 4 seasons to a extreme reading. And you want to see on an intraday basis that this was about 1.5 frog boxes. That will tell you undoubtedly that was a large move and a harsh winter. And the reason we want a harsh winter is that because most of the time price stays in some kind of sideways choppy, and then only periodically do you get these large directional moves when either the bulls or the bears establishes a victory for their side. And when that happens, we think of the target as being in play, that it's game on. Now, when you see a large move to the downside, the kind of move that would lead to a hybrid, to a harsh winter, and ultimately this SSC, that's in play. And then let's look at the demographics that are interested in the fact that we just saw an abnormally large sell-off. First of all, you got the bears who just won, like the people who got short inside here and then watched a harsh winter develop, these guys are double plus happy because they just won and they would like some more. So they have skin in the game and a vested interest so that when this thing gets to some kind of temporary bottom, they're now thinking, yeah, let's take this down for another large move, the second leg, which they want to be as big as the first leg. Now, who else is interested in this? Well, you also have the sharks, or if you're a land-based animal, hyenas. And these are the ones that didn't get the initial kill and are saying, hey, I need to hurry up and get some more of this. And I would like to participate in the second leg down. So they want to see this thing go down. The bears want to see it go down. The sharks want to, and hyenas want to see it go down. And then on the other side of this trade, so we might think of these two groups as the ones who are wanting to see this thing go down. And then you have a group of folks who say, aha, look at this opportunity to buy something on sale. They got no skin in the game. And they say, oh, this is probably an overreaction. So now we can come in here and buy this thing and get it on sale so that when it goes back up to something like it's closer to its fair value, we're getting quality on sale. And so that creates an urgency on these guys to come in and buy. And the fact is, when you see that this has already started to turn, the fact that it has failed to fail further, it gives you evidence that there's some people coming in here already doing that there is more buying pressure here. Because if there was no buying pressure, this thing would have just kept failing. But it didn't do that. It started to go sideways. The only reason it goes sideways is because either the bears are full. No, they always want more. But no, the reason it starts to stabilize and fails to fail further is that buying pressure has come in and has started to flatten this curve out. So now if it actually starts moving up, they're starting to win a little bit. How much do they have to win before we become interested in this as a second mouse? Well, we want to see the dragon, which is that slower 10-period moving average, plus or minus a half a standard deviation. We want to see that thing get crossed. When the price and RL10 cross the dragon, that is evidence. That's evidence that there was enough buying pressure and volume from these guys that are buying it on sale to overcome the combined power and effort of sharks and bears and hyenas that want to drive it downward. Now, do they have enough power to really drive this thing all the way back up to fair value or to wherever the fair value was before? Well, I don't know. But the hypothesis is that if I can create a tiny risk box in here, my minimum manageable risk box, then I'm getting paid 1 or 2 or 3 or 4 units of reward for the small measured risk that I'm willing to take on the basis of the hypothesis that I've seen enough evidence to suggest that this might be the case where the guys buying it on sale will overcome the bears and the sharks and the hyenas and add power and buy this thing on sale and drive it back up. That's the hypothesis. Now, that hypothesis comes with it automatically a marker which says, however, if price falls below the belly of the RL10, then this ain't happening. Hypothesis over. Experiment concluded. All right. So there was the price level that got me in to see if to benefit if this thing goes north. So the green line is the price that gets me in. The red line, according to this theory, is the price that tells me that it's more likely the case of the second leg happening and that the bears and the sharks and the hyenas are winning, and we're going to see a second leg as big as the first leg. That's just a continuation of the primary trend. This thick red line then, which is the initial stop of the SSC, is also the demarcation line as the entry for the collapsing dragon. It is both of those things. All right, because the experiment has been concluded. This thing is going down. And that's the collapsing dragon. So now that I put that in context, let me say then that the area of uncertainty is this price box between the entry level and the exit level. This area inside here is the yellow zone, where price can monkey around as much as it wants, and I don't care. I have no new information about the status of this trade, about this hypothesis, until that yellow box can no longer contain the price. When price comes out of that box, then I'm following price because I want to be on the winning side. I know on the basis of how far it fell during this harsh winter, I know that there is already a real sense of urgency and opportunity among the bears and the sharks and hyenas, that if this thing starts to fail, then there's going to be more guys rushing in to get short to push it down. And all of these guys that were trying to buy it on sale are going to bail because they're saying, hey, it's not going up, so we're going to get out of that position. Not only are they going to stop buying it, they might even reverse and get short, but they're getting out. They are not buying. Plus, you have a bunch of guys that are selling. That price is going down. That is the path of least resistance. That is the path of maximum pain for all these guys that owned it back here. This is the herd. Oh, by the way, that's the fourth group. The guys who already own this thing because they thought it was going to go up from here. They're the ones that got surprised by this thing getting smashed to the downside. Some of them, if they're traders, might be the ones that want to come in and buy some more of the good stuff on sale, but typically they're not. Typically, they've already made their play because they already think it's going up. So it's only short-term traders that are coming in to buy the dip. Most of the long-term buy and hold guys are fully invested all the time because that's what their theory says. It's a small amount of guys that also have extra money ready to buy every dip. I mean, some can, but those are the guys that are suffering. In fact, those are the guys who are panicking and selling because they want to preserve whatever gains they already have. So those guys are actually on the side of driving it to the short side because they want to get out of the position to preserve their gains and preserve their capital. So against those three populations, the only guys on the other side are the ones that are trying to buy quality on sale in a tentative way, in spite of all the evidence that this thing is going down. But sometimes they win. Sometimes this thing really does cross the dragon and go up. So now, what happens if a collapsing dragon happens quickly? Here's how you play that, by the way. What you do is You decided where you were going to get in on the north side of the dragon. That's where you're going to get in. So while you see price moving up, this price starts moving up and it's horsing around in the yellow zone and it's getting ready to go up. And you say, oh, there's the price I'm going to get long at up here on that green line, right? I'm going to get long here on that green line. So what you do first is you put your sell order in here. You put your stop order in first. Now, one of three things is going to happen. First, the one you hope this thing just fails and gets you short without you ever getting long. Why is that good? Because it didn't even get across the dragon. It just started failing again. And that's evidence that this leg 2 is going to happen. So you love that. So put the stop in first. Then put your buy signal in second. And then if it gets in and then starts to fail and then hits your stop, that's an instant stop and reverse. So you could actually make 2 positions short, 1 position long. So if it gets long and then reverses, this one exits and shorts simultaneously with a position of 1. So you're net 1 short. So you don't have to think in the moment, what should I do? You already decided what to do. Here's when you decided what to do. You decided what you were going to do when you drew the first box for your MMRB, and you decided that this was the price that would get me in, and you decided that this is the price that tells me that the hypothesis is over and that I want to get short on the collapsing dragon. You decided that your yellow zone was inside of this box. As long as price is just monkeying around inside here, there's no new information. This is the noise area. So if it comes out of the box and you're long and then stops and goes this way, you close the trade and you get short 1. That's why I like to put that one in first, because this is my favorite pattern. I would love to see price come down, try to get out, and then immediately fail. I don't mind taking that loss because this is going to be the big one. But if it actually gets across the dragon, I have enough evidence that this might work. Here's the dragon that's come down. And I required this much of a move to get across the dragon to get me long. And I've just decided I don't believe in this trade. The trade I believe in is the collapsing dragon. And I don't even believe in that one. And that's my favorite one. The SSC is my second favorite trade. You know what I would rather have than my second favorite trade? My first favorite trade. So I hope this thing fails because I know exactly what I'm going to do. I'm exactly going to get short right there. Already in play, ready to go. So I'm not doing any thinking inside here. Once I build my box, I'm going long from here or short from there. Price, you tell me which way I'm going. I don't care. Now, what kind of mindset do you have to have in order to be able to execute that? Well, the first thing you have to have is instant execution and no hesitation, which means that you have to have small position sizing so that you're not thinking about the dollars at risk. Oh, what could happen? Anything could happen, and it usually will. So what? That's what it does. You want to be in the trade long enough so that you can do 1,000 trades like this so that you get the expectancy and that you can just simply execute according to the rules. So if you can't stop thinking about it of what to do inside of this box, it means you got too much capital at risk because you're thinking about the money and what if instead of just following the rules. Just follow the rules. Study the rules, study the results, use statistics and data analysis to sort it out. Learn how to make the risk box smaller so that the amount of indecision is smaller so that you can get into the big moves earlier with smaller risk, which will increase the size of your execution risk, which will increase your confidence. So you asked me, can I give you some insight about what to do if the CD happens quickly? You hope that it happens quickly. The way you manage it is by already having your short position entry locked in so that price puts you into the position, not your decision. You want to see price lead to action. You don't want to see price lead to thinking, planning, and then deciding to act. You want to get rid of that. You want price to lead to action. That means you got to do all your thinking beforehand, put all your price levels in, and then let price lead immediately to action. So if you see it moving and you don't have it in play, leave it, wait 15 minutes and come back or whatever. Don't trade if you're not ready. Time, will, pattern, and money. So be ready to enter and understand what that risk box really represents. Now, depending on the time frame that you're operating in, the day trading one is the one that you are most likely to feel time pressure on. And you want to make a deliberate plan to act. One of the things that you can do is when you learn to look at the market in terms and these trade frames in terms of that MMRB, and you can say, I just noticed that this thing went out of the box. Well, what that really means is this was my ideal entry. And then that's based on the idea of I've estimated what the potential reward was. Maybe that was the size of leg one, or maybe that's the last place there was support and resistance, or maybe that's the Z3 line, or maybe that's the return to the VWAP. Whatever that reasonable target was that tells you a move from the current price level to here is not unreasonable, you can simply take a look at this and say, is there enough time for me to see if I could get in here quickly, and if that's my risk box now, because this is still the price up here that tells me that that the trade is no longer valid. If that's now my risk box, do I have 2 to 1? If so, then you go. If not, then you no go. 2 to 1. Now, you could make that stricter and say 3 to 1, but nothing less than 2 to 1. Let me know if that was clear, Les. I'm going to assume it was until you say otherwise. All right. Next. I notice I'm starting to take a wider view of the chart when day trading. I have moved from focusing on watching the price go up and down, and I've made a checklist to myself of what to keep in mind. Is there a pattern forming according to the rules? Yes. Now what you're doing is you're seeing price happening inside this box, right? And you've decided that, hey, there is some larger trading frame that I would go long here and I would go short there. And now you can actually watch this thing happen. And now you realize that you have some amount of time. If this is where the time currently is, you can estimate, hey, how long would it probably take at this rate, or how far does it have to go before it triggers my space? Now, if I can do that, I can now get out of the hyper focus on price right now and look back a little wider. And now I can go see, where are the previous levels of context? What are the other things looking out here in the future that are going on? Are there other trade frames that I can be looking at once you get out of the focus on a single target? So as you develop confidence in your ability to rapidly frame and then execute, that now frees up your attention, that when this is being normally managed, you can now start looking at some of these other areas, and you can start looking at, hey, where's the VWAP? Where's the 270? The high and low of the day gives you this larger context of price action for the day so far. And now you're able now to desensitize from the immediate target. You can use wider vision. You're using your peripheral vision. What is in the periphery or the other context before, during, after the particular thing that you're stalking? And seasons of the MACD, high and low, 270 VWAP. That's a pretty good set of 5 things: the pattern, the VWAP, the 270, the high and low, season of the MACD, slope of the MACD curve, slope of the RL30, relationship of the dragon to the RL30 and 10, some of that. That's good stuff. I would say that's a pretty good set, and master those first. Once it's second nature, then you can think about adding, but I don't know that you need more than that. You know, the RL90 is a nice, you're already looking at the 10 and the 30. The 90 is that intermediate regression line. That's the next higher time frame. So knowing what that slope will give you early warning about turning points in the RL270 as well. So finally, I have more time to day trade in 2022. Keen to stick to one stock like Luke does. You seem to have landed on NVIDIA. I think it's appropriate. I sent you a note earlier and say, here's why. It's legitimately volatile. It's a large cap. It is the leader in the semiconductor space, which is a leading indicator of the business cycle and has everybody's attention, and they are crushing it. And they're a great company, and very small spread between bid and ask. And there's a lot of technical and fundamental analysts looking at it. So there's a lot of things that are going to make that price continue to move around. So that has all of the features of a good day trader and swing trader, like a frog champion, that you want. So in the same way that CLF is a good day trader and swing trader, NVIDIA seems like a nice one to work with. That is a good one that meets all the criteria of what we want to see in a trading target. Like if NVIDIA was moving along like this on day charts, and then suddenly had a bad earnings or something, and it went down, you can imagine there's going to be fundamentals who say, hey, buy NVIDIA on sale, drive it up. So you're going to get a lot of fundamental and technical pressure to move it up or to move it down. And what you want is the volatility and the volume. That's a great target. All right, that's everything I want to say about the Q&A session for the Foundations course. So thanks for hanging in there. All right, let's take a look. Let's take a look now at the. Here's one from Les on NVIDIA. I thought this was a good intraday trade. I really like that you got to no lose plus dinner for 2, got paid, and then took no overnight risk, with the market in a very vulnerable position and with NVIDIA showing some weakness. people are going to look at that and say, oh, I can buy NVIDIA on sale, or this thing is failing. So why take that overnight risk on a swing? I think it's likely to be involved in a larger move on Monday. So let's wait and see. Start it as an intraday and then build the swing trade from that. To me, this looks more like people trying to scare it down from the VWAP. And I would not be surprised that they're buying inventory and then going to run it up on Monday. So we'll see. That's one of the scenarios. All right, here's a swing on Westpac Banking Corporation. Lots of good reasons to be interested in this one. This was probably an earnings gap. So this is daily charts. And one support, two legs down, support. This support, so now if we compare these two support levels, right? First of all, we notice that leg one down was as big as leg two down, or I should say it another way. Leg two was as big as leg one. Now notice that it has stayed longer in this support level to the point where the PSAR flipped and you saw a little bit of upward buying pressure. You didn't see that down here. More people are coming in to buy this at that price level than bought here. In this case, the bears and the sharks and the hyenas won. And everybody who owned this from up in here that could be tempted to sell sold during leg one and then had their hearts broken in leg two. And now there's nobody left to sell. And the fact that it has failed to fail further and started to hook up made this an interesting candidate for your swing trade here. When you got long at the PSAR flip with a stop and you gave it 1, 2, 3, 4 days to work. It worked briefly, but then fell off. And then you said, you know what? Let me just get paid and have no overnight risk. Why is that a good idea? Because you know that if it goes up and it broke through Friday's high, you still have a good move to the Bollinger Band mean and the far side of the river with a nice tight stop. You can get back into this. I mean, here's the next support level here. And then here's another one. And then if it gets through those two, it gets back to fair value. There's plenty of time. This is a financial services company. It's banks. It's not a growth stock that's going to go like that. This thing's going to go kind of like this. So why take the overnight risk? Get paid, see what's happening on Monday, and then decide if you want to get back in so you took no over the weekend risk. I like it. All right, some Ken H trade frames here. Roku. Leg one sell off, support. Leg two sell off, support. Had one little effort to go up and failed back down to support. And is trying another leg up. So this is actually like a higher low. That was an SSC inside here. He's waiting to see second day follow through. And then there's still a really nice target here to 260. Probably 265. So that's really $30 of upside gains, and 236 to about 225. That's about a $10 risk. I think if I took this, I would put the stop here. I'd take half that risk. Let me see this thing really work. Then if I can get to no lose quickly, I can have twice the position size on half the risk. Because if it gets above that Z3 pinch, this was day one, day two, and it's continuing, I think that's the winner. I think I would also use 230 as the symbol to get short. Like I wouldn't wait for it to fall all the way back to here. I'd like to get that earlier. I think 230 is where I'd look. Tell me how that works out. Cisco. The last swing cycle. Harsh. This made a lower high, harsher low. But now here's the kata 2 and it's cleared. This thing feels like it's ready to go. So it's cleared those daily charts. It was a quick run up, sold off and getting ready to go again. If that holds support and you're long at about 60, that's 60 cents risk and no overhead resistance, that's free and clear. And then if that fails, it should get back to this 59 pretty fast. And if that fails, to here and then to here. So you got 1, 2, 3 scoops to the downside, 4 if you go to here to 57 and you're only risking 1. That's perfect positioning. Zoom video. Yeah, nice. Instantly. Man, that's what support looks like on the long term. It's cleared the deck. The same place that it held last time for an amazing, and they were fighting it all the way down. Kept trying to recover, kept trying to recover, kept trying to recover. This should be able to get to 250. And double bottom, the RL10 is rolled over, turned into the fall. Man, I wish you'd have bought it right there at 195. I wish you'd have bought that. Because this is the first sign of resistance at 220. So you got 20 bucks of upside and really only about $5 of risk. Like it. And then if this fails, there's enough room at back to 180 just to play that as a short. And then you get 2 positions from there. Hard to imagine them losing money given the lockdown that's happening all around the world because of Omicron. Omicron is a gift to Zoom. And boy, is this on sale. Wow. CrowdStrike. I automatically don't like these guys. They sound like a bunch of punks. Tech geeks, but they got a double bottom put in. The weekly support is in. Lots of room to get back to the Bollinger Band mean at 250. That's the weekly Bollinger Band at 250. A low, a higher low, a second higher low. I'd go right here, Ken. I would not wait for 210. I'd start getting this right at as soon as it leaves 205. I'd get my first piece in. And then if this doesn't follow through, scratch it. But if it does, now you got a really good entry level and 230s in sight. And then if this fails, I'd go here. I wouldn't even wait for this. I'd go at about, that looks like to be about 200. Nice round number. I think I'd have a pretty tight risk, maybe a $5 risk inside here. And I'd be ready to go on a tighter box. Rene Sola. Little head fake, fake 1 and go 2 after this sideways quiet channel. Psych cleared the deck. The corner has been turned, is crossed. There's your PSAR flip. Yeah, as soon as this is ready to go, go. And stop right there at perfect. And then if that fails, you can see this getting back to 5. And that's a 16% move. I'd add my second position like right here. And third position here. I would look for resistance right there at 7 though, because all these guys that bought here, if they got it up to 7 and started to fail, hey, they're all looking at like a 20 to 30% gain in hand. So if it starts failing here, don't stick around. SCO is the triple inverse oil. This would look, this wins when there is a decline in the price of oil. That was the last one. So that feels natural and easy. Yeah, just that's straightforward. If it breaks above this thing, that's a quick run to here. So you're looking at about a $2 gain for a 25-cent risk. 8 to 1. That's one that you want to play quick. Don't let that become a swing trade. If you have a clear winner and it starts to stall, cash it, because oil is whippy. You know, it has sharp moves and then just as fast. Look how fast the reversals happen. You know, so when you have a bird in the hand on that one, get paid. Moderna. I'm on Team Moderna with my third shot in my old aging body. Swing low. Kenneth. Higher lows. Caught a 2. Ready to go. Step 1, step 2, step 3. All of those little Kata 2s just begging for support. Yep, all the way up. You know, that's a significant resistance level at 310. So that's $15. So if you could do this with $5 at 290, I think you'd be happy with, you'd be happier. Get a twice as large the position, but that means you got to cut it faster. But I think if it gets through 310, then you got to, here's the next resistance level, 330. So in that case, having just a $5 risk is going to be beneficial. Hard to see how they are going to lose money with Omicron. And then the weakness in the Johnson & Johnson solution. All right, here is Treasuries. They're putting in a nice stealthy little move here. That's a Kata 2. And all it's got to do is get through 151. It's knocking on the door. And the S&P is poised really for a 3 to 5% collapse here in the short term. If that happens, it'll get to 154 in a hurry. And then that's where I would really be in the profit preservation mode. This one's ready to go on the defensive play. Good one for the futures, by the way. Last one, Builders First, basic materials, nice consolidation. Yeah, the break of 76 feels like that would be decisive back down into here. Yeah, I think the downside on that one is one, because I think that because of that gap, this thing would run down to 74 pretty fast and then down to 72 pretty fast. Ken H asks, span of control question. Sometimes several of my swing trades get stopped out at the same time. And it takes time to reframe them. Well, that's where I think you got to get, if you have, you might have like 4 swing trades working. And then, and so I think of those as a little population of chips. And then if a bunch of them all scratch out, I think you just got to say, you know what? It was time to get out and to raise capital. And let me just take that as a sign that it's time to be an intraday trader, and then start building the intraday frames only. And then only in the last hour, think about adding take the 2 best positions that you like, if they're closing well, and then look to regenerate the swing trades. Just focus on the day trades, pick not more than 2 to re-enter, and treat that as a new phrase. When a bunch of your swing trades all fire at the same time to exit, that's a sign to get out. Don't be in a hurry to reconstitute the full array of swings. Just concentrate on the day trades to be the good day trades. And when you're using the 30-minute or the 60-minute, I would just add them. I would pick on just getting the 2 best. And that way you can always add later. Don't be in a hurry to reconstitute a full swing exposure. Because if a bunch of swing trades all fail at the same time, maybe there's some kind of hidden correlation and the market's turning. So I would just concentrate on the day trades, trade them well. Then if they start showing signs of being legitimate swing trades, then pick 2 and keep them and go. Okay. That's what I'd say on that one. So I like this one in either direction. I think this is one that is especially ready to collapse. It's had 2 chances already to get above the previous swing, and it didn't. So that feels down to me. So the short side coming back to 73 feels natural. Okay. All right, guys, that's everything we got for today. Let's get this published and posted, and we shall see you tomorrow for some other trade frames as we approach the Christmas season. Take good care and see you tomorrow.